If your portfolio is currently down and if you are sitting on losses, then this video may help you, because in this video, I'm going to discuss why the market and the portfolios are totally out of the sync. And secondly, I'll also talk about how can you look at and review your portfolio so that you can make some good changes in your portfolio and bring it back on track. If you don't know me, my name is Rahul Jain. I'm a SEBI registered research analyst, and I do a lot of analysis and I share that analysis on my YouTube channels. If you're not yet a subscriber, don't yet subscribe to my channel. Watch this content for a few minutes, and if you learn something new, gain some new perspective, then become a lifelong subscriber of my channel. With that, let me get this video started. Now what you see on my screen is Nifty is almost at 26 level, right? Give and take 100 points here and there. I don't know when you're watching this video, but the $1 trillion question is that Nifty has regained its all-time high levels almost, but the stock portfolios are bleeding. What is causing this disconnect between Nifty and the portfolios? In fact, Nifty from 1st of January has gone up by 8.80%, which of course is not a huge return. But if you look at the portfolios, they might be down by 10%, 20%, 30%, and so on. Now, there are two reasons for this disconnect between market and the portfolio. Let me give you some perspective. Reason number one is that if you look at Nifty, why is Nifty all-time high, or it's almost all-time high? Mainly because 25% of Nifty's stocks, constituents, have contributed almost 80% of its rise. And to be very, very particular here, Reliance, HDFC Bank, Bharti Airtel, SBI, L&T and Axis Bank, these 6 stocks have accounted for almost 60% of index's overall gain. These stocks are not recommendations, by the way, but the point is that Nifty is highly concentrated index as far as I can see. And if 6 to 7 stocks move upwards, the Nifty works like a charm. And if these 6 to 10 stocks do not behave, then Nifty comes into trouble. Now, the second and even more important reason for disconnect between portfolios and market level is because, have a look at my screen and you see that mid-cap index in the last 1 year or so has moved up by only 0.95%. Okay. And if you look at small cap, for example, it is actually down YTD basis minus 10% or almost 11%. So the market is very, very divided. Nifty has gone up by almost 8.8% at the time of recording this video, of course, and mid cap and small caps have not performed at all. And if in your portfolio you have high concentration of mid cap stocks and small cap stocks, but natural that your portfolio is bleeding, you are sitting on heavy losses. Now, before you go and make a perception in your mind that mid cap stocks are bad, small cap stocks are bad, please have a look at this data and let's try and understand why is that mid cap and small caps are not performing. So what you see on my screen is Nifty mid cap 150 yearly returns, and I'm showing you the data of last 10 years or so. What you note, 2014 Nifty mid cap index gave 60% returns. Okay, massive returns, 60%, right? Good returns. 15, 16, what happened? 8%, 5%. Very, very moderate, not even FD beating returns. Have a look at 2017. Because last 2 years were very moderate, in 2017, it rose up to 54%. Again, massive returns. Then again, look at the next 2 years, minus 13%, 0.28%. Then again, have a look at this, 24, 46% returns the following 2 years, followed by only 2% returns. And in the last 2 years, 23, 24, massive rallies, 43%, 23%. 2025, 3.5%. This is as of November 2025. Therefore, you see slightly higher returns. Point is very, very simple that in couple of years time, when mid caps and small cap rallies like anything, there comes a time that both mid cap and small cap typically takes a breather. That's what the past data is telling you. In fact, let me show you for small cap as well. Very, very similar pattern in small cap as well. What you see here is, for example, in 2019, they gave minus 7% return. But what happened the next year? 25% returns. Following year, 61% returns. Massive bull run in 20 and 21. Have a look at in 2022. Again, minus 3% returns. 23, 24, very good rallies, 48%, 26%. In 2025, now they are down by almost 8% as of November, or 10% or 11% as of when I am recording this video. Point is again very, very simple. If you are thinking to quit mid cap and small cap, that is not a strategy that in my view you should adopt. Right? Just because an index is down by 9%, 10%, and you feel like that these are the bad indexes, That's not the way to look at indices. You have to look at the cyclicity of these indices, and that is what will tell you that in fact the best time to invest in these indexes is when they are down by, let's say, 9%, 10%. That's what the data is showing you. See, in 2022 it was down by -3%. People who invested there got rewarded. 23, 24, very good returns. Now again, I cannot predict the market, right? The pattern is there to give us some indication, give us the nature of these indices. I can't tell you that in 2026 mid cap and small cap will rally like anything. I can't make that irresponsible statement, right? Because I can't really predict the future. But what I can tell you is that don't get panicky about your portfolio if you have high concentration of mid cap and small cap. I'm going to actually walk you through now how you go about reviewing your portfolio as of now. I can't really solve your problem like this, but I can promise that if you watch the remaining video, you're going to learn something which is around how to manage your portfolio. Maybe because you started your portfolio with a very, very wrong expectation. So let me go through and give you some views around how to go about fixing your portfolio. It may not be fixed immediately like a magic, but if you work on this portfolio, let's say for the next few days, weeks and months, I'm sure you can bring it back to the track. Before I do that, if you're so far liking this video, request you to hit the like button. And if you gain some perspective here, become the subscriber of this channel. You're going to learn a lot because I back my arguments with data. Now coming to your portfolio and how to go about fixing your portfolio, there are total 3 strategies that you should look at deploying at your portfolio level. Let me run through all these 3 portfolio strategies and I will give you some examples as well so that you can get good clarity on these 3 strategies. Strategy number 1 is your portfolio review and rebalancing, right? So forget about whether to buy or sell. Just concentrate on your portfolio for now. So how to go about reviewing your portfolio and rebalancing is, first step is get a pen and paper or download a report of your stocks and mutual funds. And what you need to do is get your allocation right. Understand what is your portfolio allocation with respect to 4 market caps. Number 1 is giant cap, number 2 is large cap, number 3 is mid cap, and number 4 is small cap. Now, as such, giant cap is not a classification done by SEBI, but many companies like Value Research, for example, they use giant cap as a definition, and I think that is quite practical in my view. Giant cap you can consider, let's say, top 50 stocks or Nifty stocks. What is the total percentage of your portfolio that is invested in top 50 stocks of India? That's what you need to get into giant cap. Likewise, large cap, total percentage of allocation between 50 to, let's say, 100, and then mid cap is, let's say, 100 to 250. What percentage of your portfolio is invested into mid cap and what percentage is then allocated to small cap? This is as is picture. What is your current picture? What is your current portfolio? And I can guarantee you that 90% people have no clue. Maybe more than 90% people have no clue in terms of what is their current exposure to these different market caps. It's extremely important, and you might not know this because you started your portfolio building very haywire. Your portfolio might be looking like a sabji mandi right now. It has potato inside it, it has cauliflower inside it, it has broccoli inside it, it has everything. And you have no idea in terms of what are the market caps, and more importantly, you have no idea potentially that what is your risk appetite. So therefore, the step number 2 here will be that you look at your risk appetite and you look at your allocation. Give you example, for example, let's say I'm categorizing risk into 3 categories: low, medium and high. And if your risk appetite is low, then your allocation needs to limit to giant cap and large cap. Because giant cap and large caps are relatively less volatile, your portfolio will not bleed much if you are into that category. Of course, then your returns might be very, very optimized according to your risk profile. Second comes the medium risk appetite. If your risk appetite is slightly higher, then you definitely can look at including mid caps into your portfolio. And third one is high, where you can also go to small caps. That's not a problem. Now, what you need to do is do an honest introspection that what is your risk appetite and how do you know what is your risk appetite? If your portfolio is down by 20% and if you're having sleepless nights, then you are not a balanced investor. You're not an aggressive investor and you're not even a balanced investor. You fall into conservative category. But if your portfolio is down by, let's say, 20% and you're not panicking, of course you feel bad about it, but you're not panicking, you're not having sleepless night, you're not having nightmares, that means that you are okay with this volatility. Therefore, you might be a balanced or aggressive investor. That's a very, very simple stick yard that you can use. Now, more importantly, what you need to do is look at your current allocation. So for example, let's say if you're a conservative type of a risk investor, and if you feel that in your current portfolio you have 20% small cap stocks, then it means your current portfolio is not fit for your risk appetite. you've got a slight clash in your portfolio and your risk appetite. And I know it is quite painful to look at this data, but believe me, you need to be honest with your portfolio. You can't really have a risk appetite of conservative and have, let's say, 20% small caps. Another example I can give you, let's say if you're a balanced risk investor and if you have 80% small caps, you might find this, that you have 80% small cap exposure looking at your stocks, looking at your mutual fund portfolio. Therefore, you're panicking now. Of course, you're panicking because you've included 80% of small caps and your risk appetite is only like balanced investor. On the other hand, you might find that you are an actually aggressive investor. You're fine with this volatility, but you don't have any small caps. So the point here is very, very simple. You need to look at this allocation. I know it could be very painful. It could be a process that you might need to spend, let's say, few hours. It shouldn't take you long really. Just download few reports from your Demat account and you should be able to easily do it. Now comes the question then, Rahul, once I have done this, what is my next step? Your next step is very, very simple. Now you can build your strategies. Now, for example, let's say you're a conservative type of investor. You had 20% exposure to your small caps. Immediately, first thing is that do not even think about downward averaging your small caps. Even though you might be having a small cap stock in your portfolio that is, let's say, 40% down and you're thinking I should go and actually downward average. What is the guarantee that this 40% drawdown will not convert into 60% drawdown or 70% drawdown? What is the guarantee? And more importantly, it is not your risk profile. Therefore, immediate action or insight that you can take by doing this exercise is that you can stop downward averaging your small cap stocks. Second is that it will also give you a perspective that maybe because your portfolio is 20% small caps, you need to possibly look at large cap and giant caps. And over the next, let's say 2 or 3 quarters or 1 year or 2 years, you need to maybe start looking at the large cap space because your portfolio risk says that if you were to put more money into your portfolio, you need to have higher allocation to large cap. And the third very, very practical tip I will give you is that get rid of your watch list. If you have in your watch list a lot of small cap stocks and a lot of mid cap stocks, but your risk profile is conservative, get rid of your watch list. In your watch list, start adding large caps, start adding giant caps. That's where your working space needs to be. You have to define your universe so that going forward, very gradually, you can just bring this portfolio on track and it gets aligned to your risk appetite. Let's take another example. Let's say you're a balanced type of investor and you find that 80% of your exposure is into small caps. What all can you do? Very simple. You stop downward averaging your small caps. Start doing some research about giant and large caps, right? Get your watch list changed. But more importantly, please do not panic just because you've got 80% small caps. Evaluate each of these small cap stocks and you have to take action at each stock level. You can't just get rid of all of these small cap stocks and book heavy losses. Please understand, a loss is not a loss until you book it. Okay, so give your portfolio some time. Take some time, take a deep breather and start looking at each stock individually. To sum up the first strategy, you go back and look at your portfolio, review what your current market cap allocations are and gradually try to align it to your risk profile. It is an important exercise that you must do. Now, some of these portfolio level strategies I speak a lot on my YouTube community as well. If you're not yet a member to my exclusive community, consider joining that. Simply go to my channel, find the join button and be my guest. Almost on a daily basis, I try to post a lot of insights about market, stocks, mutual funds, etc. that will make you a very good learner over a longer period of time. The feedback of this community has been very, very good. With that, let me move to strategy number 2, which is all about sector allocation. It is extremely, extremely important. I try to stick to a thumb rule, which is that no single sector should get more than 20% of exposure in your portfolio. And this is a thumb rule that I am trying to follow. And this is also used by a lot of mutual fund houses. For example, if I talk about Parag Parikh Flexi Cap Mutual Fund, I was looking at their portfolio as of November 2025, total 63% allocation in Indian equity. And within that, if you look at their sectoral allocation, I did this pivot table and found that only banks have around 20% allocation, right? Look at all other sectors, 4%, 5%. You really need to make sure that you are not having one particular sector allocation which is beyond 20%. If you're having that, then of course you're taking a very, very high concentrated risk, and only seasoned investors do that when they exactly know when to enter into a sector, when not to enter into a particular sector, when to exit sector. So if you're not an advanced investor, my simple advice for you will be that look at your sector allocation and adjust it accordingly. Now you'll say that, Rahul, what actions can I take? So for example, let's say you look at your portfolio, stock portfolio, and you arrive at, let's say banks you have 50%, auto you have 30%, IT you have 20%. I've just made it up as an example and for discussion point. Now, if you have this kind of allocation, immediately you would know that, you know what, banks, I have already 50% allocation. I'm maxed out. I shouldn't really go beyond that. In fact, I need to look at booking some profits if there are opportunities. If you look at auto, you're 30%, very, very high, 20% IT. Again, these are very, very high exposures if you've taken. You need to gradually move into more diversified portfolio. And within these sectors, if you have any stocks where there is some profit, then consider booking that profit or review that particular stock and see if valuations are overstretched, then maybe this is the time for you to book your profits and accordingly take stock level decisions. But you must do this exercise of looking at sectors. And a very, very good way of looking at new sectors is look at which sectors have not performed in the last 1 year. Looking at the sectors that have underperformed might give you good opportunities. For example, here on my screen, we have got a lot of sectors here and I've arranged them from most beaten down sector to least beaten down sector. For example, here in the last 1 year, telecom sector has been beaten down, 27% drawdown. Hotels, bad performance, 15%. Software, IT, we know 13% around at the time of recording this video, which is on 18th of December. Media, for example, 12% down. Reality, which is the construction space, 10% down. So again, you can see all these sectors. And what you need to look for is that if the profit growth is there. For example, here, if you look at the net profit growth rate quarter on quarter, it is showing you the latest quarterly results. And if you look at, for example, telecommunication, the profit growth rate is not there, it's negative. So maybe it's a caution here, right? There are right reasons for it to be down. Hotels, on the other hand, 17% up, right? So maybe we need to look at some hotel stocks. If you look at software services, which is down by almost 13% as of now, there is some profit growth rate, 2.3%, but it's not completely what it was maybe quarter back where the IT stocks profits were falling down. There was a degrowth. So definitely there is some recovery here. Media, for example, is still very, very down. Reality, good profits, 13%. So, you need to explore these sectors and try and move to the sectors that you are comfortable with. And at the same time, do not have that allocation which is very, very high to one particular sector. This itself might bring your portfolio back on track. Now comes the third strategy, which is all about diversification. Just few days back, I released this video on my channel where I talked about one of the biggest mistakes I have done personally is that not diversified my portfolio a lot. So in this video, I talked about, for example, how much of allocation I intend to do in 2026, which is around Indian stocks, global markets, gold, silver, etc. You need to have a diversified portfolio so that your returns are optimized, your drawdowns are limited. Typically, people struggle because they will put 100% of their money in Indian stock market, and then all of a sudden, if the market is not performing, they're going to say that the markets are bad. Actually, it's not the markets that are bad. It's you have not made sure that your portfolio is diversified. I've done that mistake a lot. In 2026, I'm going to go for a diversified portfolio. So for this, what you need to do is look at your overall portfolio, not just the stock portfolio, look at everything else and come up with your current exposure. How much is the current exposure for, let's say, Indian market, global equities, gold, silver, Bitcoin, corporate bonds, liquid funds, FDs, whatever you have, make a good list. Look at the total allocation and ask yourself, is this the diversified portfolio you want to hold? Right? If you're not getting good answers, go to a financial advisor who can review your portfolio and can tell you that for your risk appetite, your portfolio allocation should be XYZ, and then gradually you start moving it. It's not going to happen overnight, believe me. But if you take the right steps, if you do these exercises now, then at least next 1 year, 2 year, 3 year, you're not going to be in such a bad situation that you are in today. If you have not yet watched this video, please go and watch that video. You're going to learn a lot practically. So that's it. In this video, I've talked about these 3 strategies. And if you follow these 3 strategies, I think you can bring your portfolio back on track. And the most important thing is that please be patient. Markets never go in one linear motion. There may be corrections time to time. Nothing to worry about. Don't feel bad and don't blame yourself a lot. Just relax. Maybe take a break from the stock market portfolio for, let's say, 10 days, 15 days, 20 days. Come back refreshed and look at the strategies again. I hope you enjoyed this video. If you did, press the like button. Also, you can consider joining my Hindi channel. वहाँ पे मैं हिंदी में बहुत सारी videos बना रहा हूँ. The content on Hindi channel and English channel will be different. It's not कि ये same ही content होगा, अलग-अलग content होगा. So if you want to go and listen to me in Hindi, then go to my Hindi channel. I have given you the link in the description in the pinned comments. With that, I hope to see you in my next video. Until then, keep rocking.